Imagine this: the stock market tumbles 30%, the headlines scream, "Recession is here." Interest rates are slammed higher, and people panic. Yet through the chaos, you see a handful of financial oases that hardly budged, or even gained, in value. What if I told you those oasis investments exist? What if you could position yourself before the crash and protect your wealth? In this video, we'll dive into the top 5 recession-proof investments everyone should know about. Not foolproof, but battle-tested. Stay till the end because these are the tools you want in your toolkit when everything else seems to fall apart. What does recession-proof really mean? First, a quick reality check: no investment is perfectly immune to downturns. The term recession-proof is relative. It means assets that tend to decline less, hold up better, or even deliver income when broader markets are tanking. These investments typically share certain traits. They provide necessities. People still need utilities, healthcare, food. They generate consistent income, dividends, interest, rents. They come from sectors or instruments backed by strength or regulation. They have strong balance sheets, low debt, or government backing. With that in mind, here are 5 types of investments that many financial experts consider relatively resilient in recessions. U.S. Treasuries and cash equivalents. When everything else shakes, many investors run to the U.S. government. That's because U.S. Treasuries are backed by the full faith of the U.S. government, making them among the safest fixed income assets around. T-bills, short maturity, T-notes, T-bonds, in particular, short-term Treasury bills often serve as safe parking places. Because their maturity is brief, you can roll them over at new rates. Treasury inflation-protected securities, TOPIs, these are especially useful if inflation is lurking. The principal adjusts with inflation, giving you a cushion. Cash and money market accounts, very low yield, but ultra-liquid and safe in crisis times. During recessions, rates often fall, so locking in higher yields via longer bonds can pay off. Morningstar analysts note that recessions often trigger a flight to quality, boosting Treasury demand. So whether you're near retirement or looking for a foundation, Treasuries and cash equivalents are a bedrock of defense. Dividend-paying, defensive, stocks and funds. Next up are stocks and funds built around companies that pay steady dividends and operate in sectors that remain essential, no matter the economy. Think utilities, healthcare, consumer staples, food, hygiene, household goods. Why dividends matter even if share prices drip? Dividends offer income. Reinvested dividends lower your effective cost and cushion downturns. Companies that maintain dividend consistency often have strong balance sheets. Some real examples: see from 2025 dividend stock studies. PepsiCo maintained dividend streaks and saw only modest sales dips during past recession. Procter & Gamble, Colgate, Kimberly-Clark. Big names in everyday goods, less sensitive to luxury spending cuts. But you don't need to pick individual stocks. You can invest via ETFs that target dividend aristocrats or defensive sectors. For example, the Consumer Staples Select Sector SPDR ETF XLP focuses on essential consumer goods. Utilities sector ETFs like XU back regulated utility companies whose services, water, electricity, gas, remain vital. As Schwab points out, in a volatile market you may prefer high-quality stocks, low debt, stable cash flow, and lower volatility sectors like utilities, healthcare, staples. Real estate and rental income, especially residential. Real estate isn't impervious to recessions. Rents can fall, vacancy can rise. But the right kinds of rental property can offer a fairly stable income stream when structured well. Why real estate helps people always need somewhere to live, even when times are tough. Mortgage rates or home buying become less attractive, boosting demand for rentals. Real assets like land and buildings can serve as inflation hedges. Residential rentals in stable areas, good schools, essential infrastructure tend to outperform commercial or speculative developments in downturns. And real estate investment trusts, REITs, focused on residential or certain essential infrastructure can offer liquidity without direct property management. That said, debt is the enemy in recessions. You don't want highly leveraged property. Also, location and tenant quality matter deeply. Utilities, infrastructure, and essential services, this is a sector play rather than a specific stock. Utilities, infrastructure, and essential services are among the most recession-resistant industries. Think electricity, water, gas, internet, waste disposal, highway tolls, broadband networks, etc. Why they're strong? They deliver necessity, not luxury. Many are regulated with steady rate structures. Often carry long useful lives and substantial barriers to entry. You can't start a new utility overnight. Regulated utility stocks frequently drop less than the broad market during recessions. Beyond utilities, think infrastructure assets, toll roads, pipelines, communications cables. These assets generate cash flow from contracts, usage fees, or regulated tariffs, and tend to show more stability under stress. precious metals and hard assets, gold, silver, commodities finally. For many investors, precious metals and commodities are the classic safe haven, or hedge against uncertainty and inflation. Gold, the most traditional safe haven. In many past crises, gold has held or even soared while equities crashed. Silver, platinum, industrial metals more volatile but may replay strong roles during certain cycles. Commodity funds, baskets, energies, oil, gas, agricultural commodities, industrial metals can diversify away from stocks. However, note caution. Commodity prices can be highly volatile and correlated with economic cycles in unexpected ways. Gold in particular doesn't produce yield, so it's more a store of value than an income generator. So instead of going all in on gold, it's wiser to allocate a modest percentage, 5–50%, as a hedge in a diversified portfolio. How to combine these into a recession-resilient portfolio? You now know 5 categories. Here's how they can be blended into a real approach. Core allocation to safe assets. Keep a base in U.S. Treasuries, cash, or short-term high-quality bonds. Foundation of dividend defensive equities. Use ETFs or blue-chip companies in health, staples, utilities. Real assets, real estate exposure either direct or via REITs or infrastructure funds. Small portions of gold to hard assets as a hedge. Diversification and rebalancing. Don't let any single investment overpower your portfolio risks. Some guiding principles: avoid over-leverage. Debt kills you in downturns. Focus on quality, strong cash flows, low debt, conservative management. Watch fees and liquidity. In crisis, you'll want flexibility, not hard-to-sell assets. Don't panic or time the market. In past recessions, many of the strongest returns came from staying invested and rebalancing at the bottom. As Schwab suggests, recessions present opportunities to tweak tactically, not to overhaul your whole strategy. The investor who weathered the storm. Let me tell you a short story to illustrate. Meet Sarah, a mid-40s professional with about $500,000 in investable assets. In 2027, she sensed economic weakness, inflation rising, signals of yield curve inversion, talk of slowdown. Instead of waiting to get hammered, she rebalanced. She moved 20% into short-term treasuries and types. She held 40% in dividend ETFs focused on consumer staples, utilities, healthcare. She kept 20% in a small residential rental property in a solid suburb. She added 10% to a utility ETF's infrastructure index fund. She allocated 5% to gold. The remaining 5% she left flexible for opportunistic dip buys. When the recession hit in 2029, the S&P 500 plunged 35%. Sarah's portfolio dropped only 10%, and the income from her dividends and rent didn't skip. Over the 2 years, she actually harvested some cash by selling treasuries at better rates and redeployed into battered blue chip names. Meanwhile, many of her peers saw 30 of 50-cent drawdowns, panicked, and sold low. Sarah held firm because she had built resilience. That's not fantasy. Many times in history, those with diversified, defensive tilts outperform the panic crowd. The greatest edge is protection and staying power. Risks and caveats. You must know, this is not a guarantee of protection. Some caveats: even recession-proof assets decline at times. Timing and execution matter. Utility stocks might be hurt if regulation becomes hostile or interest rates spike. Real estate can suffer from local oversupply, vacancy, or financing stress. Gold and commodities can swing violently, especially on macro moves you can't predict. Inflation, interest rate shifts, policy risk, all can hurt even safe assets. Always tailor to your risk tolerance, time horizon, and tax situation. And before making big moves, consult a financial advisor. The top 5 recession-proof investments recap. Here's a quick recap. U.S. Treasuries and cash equivalents: safe, liquid, government-backed, dividend-paying defensive stocks, funds, utility, health, staples, real estate, day rental income, residential and stable markets, utilities, infrastructure, essential services, monopoly-like, regulated cash flows, precious metals, hard assets, hedge, store of value. These aren't magic bullets, but they help you build armor. Even if the next recession is mild or short, having part of your portfolio protected gives you optionality, confidence, and resilience. If this video helped you see how to shield your investments when the storm hits, that's exactly what I hoped for. If you want more deep dives into resilient strategies, sector breakdowns, or real-world case studies, hit that subscribe button, turn on notifications, and you won't miss a future video. Drop me a comment which of these 5 is your favorite or which one scares you the most. I'll read every comment. Stay smart, stay disciplined, and until next time, invest wisely.